I need to start this video with something that most financial YouTube channels will never say out loud. I was wrong. And not just slightly wrong. I was wrong about one of the biggest predictions I made recently. Silver just dropped nearly 7% during a war. Let that sink in for a moment. Not during peaceful economic conditions, not during a booming stock market, during a geopolitical crisis. At the exact moment when precious metals are supposed to shine, missiles were flying, oil supply routes were threatened, global tensions were rising, and silver fell. If you follow precious metals markets, you know how unusual that is. For decades, the standard assumption has been simple. When geopolitical risk increases, investors run towards safe haven assets like gold and silver. But this time, the market did something completely different. And today, instead of pretending everything went according to plan, we're going to break this down honestly. We're going to examine what actually happened, why so many analysts, including myself, got this wrong, and what the new outlook for silver might be moving forward. Because if you want to understand markets, you cannot just celebrate when predictions work. You have to analyze when they fail. So in this video, we're going to cover 4 major things. First, we'll look at the actual data, what gold and silver prices did when the conflict started. Second, we'll perform a thesis autopsy and examine the arguments that predicted higher silver prices. Third, we'll analyze whether the long-term bull case for silver is still intact. And finally, I'll share updated predictions about where silver might go next. If you're new here, my name is The Stack Guy, and this channel is all about understanding money, markets, and the untold stories behind them. Let's get into it. Section 1. What actually happened? To understand what went wrong, we first need to reconstruct the timeline, because markets often react not just to events, but to expectations. At the end of the previous trading week, silver had been performing incredibly well. Prices had surged rapidly, reaching roughly $29 to $30 per ounce, depending on the exchange and futures contracts. Gold was also strong, hovering around $2,350 per ounce. Momentum across precious metals was extremely bullish. Many analysts believed that geopolitical tensions in the Middle East would push prices even higher. Historically, that assumption has often been correct. During times of conflict, investors frequently move capital into safe haven assets. Gold tends to lead that movement. Silver usually follows. But when markets reopened after the weekend, something surprising happened. Instead of rising, silver gapped down. At the open of electronic trading, silver dropped sharply and continued sliding through early trading hours. By Monday morning, prices had fallen roughly 7% from recent highs. Gold, meanwhile, remained relatively stable. It moved slightly higher, but nowhere near the explosive rally many analysts expected. So why did silver fall while geopolitical risk was rising? To answer that question, we need to examine several other factors affecting the market. First, the US dollar index, often referred to as DXY. During global crises, capital sometimes flows into the US dollar rather than precious metals. In this case, the dollar strengthened slightly as investors sought liquidity and stability. A stronger dollar can put pressure on commodity prices, including silver. Second, we have to consider market positioning. In the days leading up to the conflict, silver had already rallied strongly. Many traders had built large bullish positions. When the actual event occurred, those traders began taking profits. This phenomenon is often called buy the rumor, sell the news. In other words, the market may have already priced in the geopolitical risk before the conflict officially escalated. And when reality arrived, traders closed positions instead of opening new ones. Third, we need to look at industrial demand expectations. Unlike gold, silver is heavily tied to industrial activity. It's used in electronics, solar panels, batteries, and countless other technologies. If investors believe economic growth might slow because of geopolitical tensions, they may sell silver due to reduced industrial demand expectations. So while gold behaved like a traditional safe haven, silver behaved more like an industrial metal. This combination created the unusual situation we saw, gold holding steady while silver dropped sharply. But the real question isn't just what happened. The real question is why so many people expected something completely different. Section 2, the thesis autopsy. Before the weekend, several major arguments supported a bullish case for silver. Let's examine those arguments one by one, because understanding why a thesis fails is one of the most valuable lessons you can learn in markets. Thesis 1, safe haven. Demand, the first argument was straightforward. Wars increase uncertainty. Uncertainty drives investors towards safe haven assets. Historically, gold and silver often benefit from this type of environment. But in this case, only part of that theory worked. Gold did receive some safe haven demand. Silver did not. Why? Because silver occupies a strange position in the market. It's both a precious metal and an industrial metal. That dual identity means it doesn't always behave like gold. During periods of economic uncertainty, investors sometimes prefer gold specifically because it has less industrial exposure. In other words, silver's hybrid nature makes it more volatile and less predictable during crises. Thesis 2. Supply deficits. Another popular argument focused on supply shortages. The global silver market has experienced multiple years of supply deficits. Industrial demand, particularly from solar energy and electronics, has been growing rapidly. Meanwhile, mine production has struggled to keep up. In theory, this imbalance should push prices higher, but structural supply issues don't always affect short-term price movements. Financial markets can remain disconnected from physical supply realities for long periods of time. The shortage may still exist, but that doesn't guarantee immediate price appreciation. Thesis 3. Historical patterns. The third thesis relied on historical precedent. In previous Middle East conflicts, precious metals often rallied, so analysts assumed the same pattern would repeat. But there's a major problem with relying too heavily on historical patterns. Markets evolve. The structure of financial markets today is very different from what it was 20 or 30 years ago. Algorithmic trading, ETFs, derivatives markets, and global capital flows have changed how prices respond to news. What worked in the past does not always work today, and that's exactly what we saw here. Section 3. The prediction tracker. Before the conflict escalated, I made a prediction. I believed silver had strong momentum and could push significantly higher in the near term. That prediction clearly did not play out the way I expected. Instead of rallying, silver corrected sharply. Now, that doesn't automatically invalidate the long-term thesis, but it does mean the short-term timing was wrong. This is something many analysts refuse to acknowledge. But in markets, timing matters just as much as direction. You can be correct about a long-term trend and still lose money if your timing is off. That's why prediction tracking is so important. It forces analysts to evaluate their assumptions and refine their models. Right now, the silver market is sending a clear message. The bullish narrative may still exist, but the market is not ready to price it in yet. So instead of doubling down blindly, we need to reassess. Section 4. Is the silver bull market dead? After a sudden drop like this, many investors start asking the same question. Is the bull case for silver over? In my view, the answer is no, but the timeline may be longer than many people expected. Let's look at the fundamentals. Industrial demand for silver continues to grow, especially from the renewable energy sector. Solar panel production alone consumes hundreds of millions of ounces of silver every year. Electric vehicles, electronics, and advanced batteries also require significant amounts of the metal. Meanwhile, global mine supply has not increased dramatically. Many silver mines are actually byproducts of other mining operations, such as copper or lead. That means supply cannot easily scale up when demand increases. This dynamic creates the potential for long-term price pressure. But markets rarely move in straight lines. Even in strong bull markets, corrections are normal. Sometimes they happen quickly and unexpectedly. And sometimes they happen during events that should theoretically push prices higher. That's exactly what we witnessed here. Section 5. What happens next? So where does silver go from here? Based on current data, there are 3 possible scenarios. Scenario 1, short-term consolidation. The most likely outcome in the near term is a period of consolidation. After a sharp move down, markets often stabilize and trade within a range. For silver, that range could be somewhere between $27 and $31 per ounce. This would allow the market to digest recent events and reset positioning. Scenario 2, further downside. A second possibility is additional downside pressure. If the US dollar continues strengthening or global economic fears increase, silver could test lower support levels. This scenario would likely push prices closer to $25 per ounce. However, strong physical demand could limit how far prices fall. Scenario 3, medium-term recovery. The third scenario is a recovery driven by structural fundamentals. If industrial demand remains strong and supply deficits persist, silver could eventually resume its upward trend. Over a longer time frame, perhaps the next 6 to 12 months, prices could revisit the 35 to 40 range. But that move may not happen immediately. Markets often require time to rebuild momentum after sharp corrections. Section 6. Lessons. From this event, there are several important lessons investors should take from what just happened. First, markets do not always behave according to textbook expectations. Even widely accepted theories can fail under certain conditions. Second, timing matters. Being right about the long-term direction of an asset does not guarantee short-term success. Third, emotional reactions can be dangerous. Some investors will panic and sell after a sudden drop. Others will stubbornly refuse to acknowledge new information. Neither reaction is productive. The best approach is to remain flexible, analyze new data, and adjust expectations accordingly. That's exactly what we're doing here. Section 7. What I am watching. Now moving forward, there are several indicators I'll be monitoring closely. First is the US dollar index. If the dollar continues strengthening, it could create ongoing headwinds for silver. Second is industrial demand data, particularly from the solar energy sector. Strong growth in renewable energy installations would support long-term silver demand. Third is global economic activity. Because silver has significant industrial uses, economic growth trends can strongly influence price movements. And finally, I'll be watching market positioning in futures markets. Large speculative positions can amplify both rallies and corrections. Understanding where traders are positioned can provide clues about potential price moves. Silver falling during a geopolitical crisis surprised a lot of people, including me. But moments like this are exactly when honest analysis becomes most valuable. Instead of pretending nothing happened, we need to study the data, identify where our assumptions failed, and update our understanding of the market. Right now, the silver story appears to be shifting from a short-term momentum trade to a longer-term structural thesis. The fundamentals supporting higher prices may still exist, but the market is clearly telling us that the path will not be as simple or as immediate as many expected. And that's okay, because markets are not about being right all the time. They're about learning faster than everyone else. If you found this breakdown useful, make sure you subscribe to the Stat Guy and turn on notifications. This channel is all about data-driven analysis, honest accountability, and understanding the real stories behind financial markets. Also, let me know your opinion in the comments. Do you think silver's drop was just a temporary correction, or is the market signaling something bigger? I read every comment, and I'd love to hear your perspective. Thanks for watching, and I'll see you in the next one.